Hello financial fans, welcome back to another stock analysis. Today we'll be covering the Clorox Company, stock ticker CLX. The Clorox Company is a cleaning product manufacturer. Right now they're sitting at a market cap of $17.32 billion. In 2022 they generated a revenue of $7.11 billion. Their dividend yield is currently 3.34%. Because the Clorox Company has increased their dividend for 46 consecutive years, they are considered a dividend aristocrat and almost a dividend king in 4 years. Some of the brands that the Clorox Company owns are Clorox, Liquid Plumber, Glad, Rita, and Pine-Sol. The revenue they generate from each sector is 41% in health and wellness, 27% from household, 16% from lifestyle, and the other 16% from various other international brands. To evaluate the company, we'll be using a margin of safety at the end of our calculation. This margin of safety will be determined by some financial ratios that we'll be looking at and the financial health of the Clorox Company. To determine this margin of safety, we'll also be using a scale that we'll get to in just a moment. When using a 4-color scale, bright red will mean a 5% increase to a margin of safety, orange will mean no change to the margin of safety, light green will mean 5% deducted from the margin of safety, and bright green will mean 10% deducted from the margin of safety. When we're using 3 colors in our scale, bright red will mean 10% added to the margin of safety, once again orange will mean no change to the margin of safety, and bright green will mean 5% deducted from the margin of safety. The first two ratios that we'll be looking at are the EBIT growth and the margin growth. Over the years, the EBIT of Clorox has steadily increased, going from $961 million in 2013 to $1.2 billion in 2021. The EBIT growth during these years was 3.11%, which, looking at our scale, means no change in our margin of safety. The margin has also steadily gone up, but took a hefty hit during 2021. During this time, the average margin growth was minus 0.46%, which once again means no change in our margin of safety. The next two ratios that we'll be looking at are the dividend growth and the payout ratio. Over the past years, the dividend has gone up, just as we talked about before, that they have increased their dividend for 46 consecutive years. In 2010, annually per share you got $2.20 in dividend. In 2021, this was $4.64 per share annually. The growth of dividends during this period was 7.07%, which means 5% will be deducted from a margin of safety. Looking at the payout ratio, this one is higher than 100%, standing at 143% and 143%, which means 10% added to our margin of safety. The final two ratios are the debt to equity and the return on invested capital. As we can see, the liabilities are larger than the shareholders' equity. This is due to negative retained earnings in the past. The ratio comes out at 5.58, which means outside of our red part of the scale, adding 10% to the margin of safety. The return on invested capital for Clorox is 10.5%. Looking at a scale, this means no change in the margin of safety. Let's go look at the valuation models that we'll be using to determine the intrinsic value of Clorox next. The first valuation model that we'll be using is the discounted cash flow model. I have imported the free cash flow going from 2012 to 2021. During this period, the average growth of the cash flows was 12.5%. Because we're trying to determine the lifetime expected growth of the cash flows of Clorox, I've gone with 40% of the average, which is just above 5%. With this 5% growth, we can determine the future free cash flows of Clorox and also determine the terminal year of valuation. Doing this, we'll be using a perpetual growth rate of 3% and a discount rate 8.5%. Combining all the present value of the future free cash flows, we get a sum of future cash flows coming in at $19.4 billion. To get our equity value, we have to add the cash and equivalents and subtract the total debt that Clorox is bearing. Doing this, we get an equity value of $16.4 billion. To get our discounted cash flow price per share, all we have to do is take the equity value and divide it by the shares outstanding. The shares outstanding currently is 123 million shares. Doing this, we get a discounted cash flow price per share of $133.59. With the current price of $140.33, we get very close to the current price, leaving a downside of only $6.74, which is close to a 5% downside. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts from the past 5 years, and we have gotten a growth rate during this period of 5.34%. Since they are a dividend aristocrat and close to becoming a dividend king, I'm expecting this growth rate to continue fully. We'll once again be using a discount rate of 8.5% again in this calculation as well. Doing this, we get a dividend discount model price per share of $157.37. With the current price of $140.33, our upside is $17.04, which is just above 12% upside. The last valuation model that we'll be using is the multiple valuation. By looking at peer companies and their stock price and earnings per share, we get an average PE ratio of the industry that Clorox does business in. Then we just have to multiply the average PE by the earnings per share that Clorox is generating. Doing this, we get a fair value at $94.26. Once again, with the current price of $140.33, the upside here is a downside of $46.07, which is almost a 33% downside. Let's go look at the final overview of our valuation next. Looking at our final overview, we have imported the discount dividend. Looking at our final overview, we have imported the discounted cash flow price per share, discounted dividend price per share, and the multiple valuation price per share. Out of this, we get an average price of $128.41. Before this, we have also calculated the margin of safety, using a standard margin of safety of 25%, adding 10% because of the debt to equity, deducting 5% because of the dividend growth, and adding another 10% because of the high payout ratio. Doing this, we get a fair value of only $77.05. With the current price of $140.33, you get a downside of 45%. Even if you didn't want to use a margin of safety at all, there would still be a downside of almost 8.5%. I hope you enjoyed this video. If you have any recommendations on a stock that I should cover in this series, let me know in the comments. Thanks for watching.